When is the next crypto bull market? Decentralized finance or DeFi has expanded by more than 1,200% in total value locked or TVL and has surpassed 240 billion in invested assets since its inception, while DeFi's TVL has since dropped to around $60 billion due to broader macroeconomic trends such as rising inflation. The seeds are in place for DeFi to reconfigure the foundations of our financial infrastructure when the next market cycle arrives. Historically, the return to a bull market takes 4 years to develop. However, this time a recovery in 2024 is possible due to the maturation of recent monetary policy and the easing of economic headwinds, which may allow for lower interest rates and the reintroduction of funding. Let's watch the video till the end to know more about the bull markets, the factors affecting them, and more. Then subscribe to Shareholder for more such uploads. Here we begin! A bull market is likely to be driven by 4 factors: the taming of global inflation, renewed confidence in the long-term viability of DeFi business models, the migration of at least 50 million crypto holders from the world of centralized exchanges to the world of decentralized applications. There are more than 300 million crypto holders worldwide today, mostly through exchanges, and potentially the next big change. Everyone is wondering where users and developers should look for opportunities in the future. Will the next cycle be a bigger and more user-friendly version of the 2020 DeFi summer? What this means for decentralized exchanges. DEXs, also known as automated market makers, have historically been at the forefront of DeFi. SushiSwap, for example, pioneered the concept of protocol-sponsored early adopter rewards and vampire attacks to entice liquidity providers to abandon Uniswap. DEXs have historically been inefficient in terms of capital, requiring large amounts of liquidity from liquidity providers to power every dollar for daily trading volume in a decentralized manner. Because liquidity pools charge low fees per dollar of liquidity locked, they rely on protocol-generated tokens to compensate liquidity providers. We are now seeing the emergence of more capital-efficient DEXs, which will most likely be followed by every other DeFi vertical. For example, Uniswap v3 enables liquidity providers to concentrate their capital in order to facilitate trading only between specific price ranges. As long as the price stays within that range, $1 of liquidity can enable many more dollars of daily trading volume, allowing for more transaction fees per dollar invested in liquidity without relying on protocol-generated token inflation. DDEX, a decentralized derivatives platform, is another example because a DDEX uses an order book to match buy and sell orders. It does not require regular users to commit liquidity in liquidity pools. Instead, it relies on much more efficient professional market makers to act as end-user counterparts. Some reasons why it is not over for the bull market to be in the crypto run. Bans and crackdowns. Tesla's decision to stop accepting Bitcoin as legal tender for its purchases, as well as China's recent crackdown on Bitcoin mining, proved to be a knockout blow to the crypto market. However, in the long run, all of this may appear to be a blessing in disguise. While some critics of cryptocurrency exist, many long-term investors in countries including El Salvador are actively advocating for its wider acceptance. With more institutions and businesses looking to adopt and accept cryptocurrency as legal tender, one company's withdrawal may hasten the process of acceptance by other brands. In addition, because China previously controlled 46% of the global Bitcoin production before its mining ban, it also provided opportunities for other countries to set up production units, resulting in greater, faster, and better production of Bitcoins and other altcoins. Mass adoption. El Salvador recently became the world's first country to adopt Bitcoin as official legal tender, with its president deciding to give away up to $30 in free Bitcoin to citizens. Primarily, Panama is reportedly planning to follow suit, as many other countries are interested in developing their digital currencies. According to Chainalysis 2021 Global Crypto Adoption Index, India ranked second in cryptocurrency adoption rate. In fact, cryptocurrencies are now considered safe assets in many countries to combat inflation and market volatility. In addition, companies such as Square and MicroStrategy are increasing their investments in the crypto sector, and many more are planning to accept cryptocurrency as a form of payment in the near future. As a result, corporate confidence is increasing the value of cryptocurrencies, which is contributing to the bull run. Pent-up demand. With employment declining due to the pandemic, people looked for alternative sources of income, and cryptocurrency proved to be a blessing in disguise in 2020. However, this enthusiasm is going to be around for a while. Businesses have begun to reopen following the recent reopening of towns and cities following a major lockdown. As a result, consumer confidence is expected to rise, as will the demand for more goods. This is where crypto enters the picture, riding the wave of increased consumer and business confidence as well as pent-up demand caused by the COVID-induced lockdowns. According to recent reports, Tier 2 and Tier 3 cities in India are largely driving crypto adoption, with Bhopal showing the highest rate of growth among small cities at 100%. Scarcity drove by Bitcoin halving. Given the limited availability of Bitcoins in the market due to the halving every 4 years, a reduction in rewards derived by miners mining a valid block of Bitcoin, there is considerable demand for this asset. According to basic economic principles, higher demand and lower supply lead to higher asset prices. The Golden Cross. A golden cross occurs when an asset's short-term moving average prices crosses the long-term moving average price. This occurred for Bitcoin in September along with another type of golden cross, that of its hash ribbon, which also had a cross between its 30-day moving average and 60-day moving average. Historically, this has resulted in a significant increase in trading volumes. The hash ribbon of Bitcoin measures the computing power being used in the Bitcoin network at any given time. As seen in the past, crypto prices over time rise whenever this rate rises. As a result, it is a sign that the bull market will continue. A shift to economic sustainability. Founders of startups can no longer rely on magic internet money. Unfortunately, this means that the market is unlikely to return to the levels of trust that allow DeFi protocol founders to reward early users with large amounts of protocol-generated tokens, thereby subsidizing annual yields of more than 100% or even 1,000% of invested capital. While DeFi protocol tokens will continue to play a role, the minting of these tokens will be scrutinized more closely. Market participants will wonder if the protocol can generate enough fees to fund its treasury and eventually retain or invest more value than it distributes to end users through inflation or rewards. Of course, this does not imply that DeFi protocols will be profitable from the start. Web3 founders need to consider unit economics, a concept borrowed from Web2 and Silicon Valley. Once large early-stage investments are no longer required, a tech-enabled business model can generate free cash flow over operating and user acquisition costs. In the world of DeFi, the concept of unit economics translates into a requirement for liquidity providers and market makers to achieve capital efficiency. Simply put, a DeFi protocol must eventually generate enough transaction fees to require liquidity providers once it can no longer rely on arbitrary protocol token inflation. So, what do you think about the next bull market? Let us know your views in the comments below and subscribe for more such uploads.